to the Management Accounting and Finance Department video lecture. My name is Mutsawashe Mbaiwa, and today I'm going to be presenting International Financial Management Part 2. So my assumption is you've gone through International Financial Management Part 1, and we're together as we are now embarking on the International Financial Management Part 2. Now let's discuss our learning objectives, which are to discuss the hedging instruments. So from part 1, we discussed some of the financial risks that come as a result of operating within the international markets, and we are now going to take it further, now discussing the hedging instruments. We are also going to discuss arbitrage. What is arbitrage? How can companies benefit from arbitrage? We are also going to be discussing analysis of foreign projects. Now let's start off with the hedging instruments. Now the key question is, how do companies hedge against transaction exposure? So remember from part 1, when we covered foreign exchange rate risk, we talked of exposure that comes in the form of translation exposure, transaction exposure, and economic exposure. So we are going to cover specifically transaction exposure. Now, how do companies hedge against transaction exposure? So say I want to import machinery. How do I hedge against transaction exposure emanating from the change in the exchange rate that will affect me when I transact to purchase the machine? So number 1, an entity can use what is known as a forward contract. A forward contract means I am able to lock or to fix the exchange rate price now that I'm going to use or that I will be transacting it, for example, in 3 months' time. So in line with this, if I want to purchase machinery worth 1 million today, and the exchange rate that I'm comfortable paying is $1 is equal to 15 RTGS dollars. So I approach my bank and then I enter into a forward contract to fix the price or to fix the rate as 1:14, so that in 3 months' time, if for example the exchange rate moves from $1 to 15 RTGS and moves to $1 to 25 RTGS dollars, because of this contract, I'm able to buy foreign currency from the bank at 1:15 and then purchase my machinery. I can also use number 2, what is known as currency options. So as options, it means I have a right but not an obligation to buy or sell. So using the same example, if I'm an importer, it means I'm a what? I'm a buyer. Since I am a buyer, I'm inclined to enter into or to purchase a call option. So I can buy a call option on the what? On currency, meaning I can enter into a contract which gives me a right but not an obligation to buy foreign currency from the bank. So say I approach my bank and then I enter into and then I buy a call option from the bank. I also need to lock the price $1 as to 15 RTGS dollars. That is the price I'm comfortable to transact. So say on the date of the transaction, that is 3 months later, if the exchange rate now is 1:10 RTGS dollars, I will opt not to exercise my right, and then I will buy from the market, hence minimizing the transaction exposure. I can also enter into a futures contract which have similar characteristics to a forward contract, where I would need to set the price today. So I go into the futures market. I want to buy foreign currency in 3 months' time to purchase my machinery. So what do? I fix the exchange rate, $1 is to 15 RTGS dollar, and say if in the 3 months, if the rate is now 1 to 14, because this is a contract which is binding, I would need to purchase the foreign currency at 1 to 15. So when we are selecting these hedging instruments to minimize our exposure, we'd also need to predict how likely what the foreign currency rate would likely be in 3 months' time, using the determinants of the foreign exchange that we covered in part 1, that is supply and demand, that is the expectation theory, and so on. So that when you enter into for example, a futures contract or a forward contract, you are actually benefiting or hedging and not going to incur further losses. And last but not least, to hedge against transaction exposure, your entity can enter into what is known as a money market hedge. So for a money market hedge, as an example, if I am now an exporter, meaning I'm going to receive money, so say I'm an exporter and I want to receive 500,000 in 3 months' time. As a company, I can enter into offsetting the amount by borrowing in the United States of America. So what do? I borrow in the United States of America, switching into rands at spot, and then I deposit the funds for 3 months. And then if in 3 months' time, I can use the receipts from the customer to pay the loan. I'll take that one again. So if I'm to use a money market hedge, what do? I'm due to receive 500,000 in 3 months' time. So what do? I borrow funds in the United States of America. After I borrow the funds in the United States of America, that is, I take a loan in the United States of America, and then I convert the loan that is in the United States into rands at spot, and then I deposit the funds for 3 months. So I switch them into rand at spot, and then I invest locally where in South Africa. In 3 months' time, I will now use the receipt of the 500,000 from the customer to settle the loan, and I'll be enjoying the proceeds from the investment that I had when I switched from the rand to when I switched from investing when I hedged my risk of receiving lesser by borrowing from the United States of America. So this will help me limit my exposure if I'm to receive amount of money in 3 months' time. So these are some of the hedging instruments that I would need to use to minimize transaction exposure. I can also invoice my customer in my local currency, that is in the rand. So I minimize exposure. If I operate in United States of America, I also invoice my customers in USD, so that when I receive money from the customer, it is in USD and I do not suffer any transaction exposure. There is also what is known as a lead and a lag, which we are not going to cover ideally, because this is not really a hedging instrument. But what I want you to do is to go and research on what is a lead and a lag, and why we're saying it's not really a hedge when it comes to hedging our transaction exposure. So we can also finance investments in foreign countries by borrowing as far as possible in the same currency. So we are saying we can finance investments in foreign countries by borrowing as far as possible in the same currency. And a typical example would be SAB Miller. I would also want you to go through and research on the SAB Miller and to find out how did the company limit their exposure to foreign exchange rate using this method of financing investments in foreign countries. Now let's move on to arbitrage. Now, in the context of the stock market, traders often try to exploit arbitrage opportunities. For example, a trader may buy a stock on a foreign exchange where the price is not yet adjusted for constantly fluctuating exchange rate. So the price of the stock on the foreign exchange is therefore undervalued compared to the price on the local exchange, and the trader can make a profit from this difference. So arbitrage is basically buying a security in one market and simultaneously selling it in another market at a higher price, profiting from the temporary difference in price. So this is considered a risk-free profit for the investor or trader. Now, if all markets were perfectly efficient, there would never be arbitrage opportunities, but markets seldomly remain perfect. So it is important to note that even when markets have a discrepancy in pricing between the two equal goods, there is not always an arbitrage opportunity. And also, transaction costs can turn a possible arbitrage situation into one that is no benefit to the investor. As an example, if the trading fees per share or in total costs more than the total arbitrage return, then the arbitrage opportunity would be erased. What's going to happen in the market if ideally there is arbitrage in the market? So as the opportunity exists, the following will occur. That is, if market participants noted that there is an opportunity for arbitrage, the following might occur. Speculators will flood to take the opportunity. Speculators will flood to take the opportunity, for example, buying lots of rand. Then what's going to happen? There's going to be higher demand for the rand, and if there's higher demand for the rand will become stronger. And what's going to happen if the rand becomes stronger? If the rand becomes stronger, then the Reserve Bank may cut interest rates. Then the result, there will be less benefit to the speculator, and the interest rates in the other country or the other jurisdiction where you're operating in might be increased in the longer term. So this arbitrage was where there's an opportunity that is the exchange, the rates in South Africa are lower, so speculators will flood and buy lots of rand, increasing demand for the rand, and then the central bank may cut interest rates. And what's going to happen to our local currency? That is, our local currency will become weaker, and the exchange rates in our local country might even be increased in the longer term as a result of this arbitrage. Now let's move on to the analysis of foreign projects. So there are two approaches to assess an international project. So number one, there's what is known as the foreign currency approach. So we estimate cash flows in the foreign currency, and then we discount using the foreign required return or the foreign WACC, and then we convert the NPV to rand, that is our local currency, using the current spot rate. And number two, we have what is known as the home currency approach. So under the home currency, we as well estimate cash flows in the foreign currency, and then we estimate the future exchange rates, and then we convert the future cash flows to rand, which is our local currency, at the end of each year. So this is how we would analyze projects. So we are saying we can either discount the cash flows at the foreign currency cash flows at a foreign currency discount rate and convert the NPV at the spot rate, or we can estimate the future exchange rates and then we convert the future foreign cash flows, and then we discount at our local discount rate. So if real returns are equal and we use future inflation rates, then both methods will result in the same net present value. Apart from the hedging instruments, how can we hedge our exposure? How do we analyze foreign projects, and how we can capitalize on arbitrage opportunities? We also need to discuss qualitative factors to consider if I would want to move or to expand my operations in another entity. So as tools to use, we need to use the Pestel model, as it is going to help us in analyzing from a political, economic, social, technological, environmental, and legal point of view, whether we should expand our operations into, for example, Ethiopia or not. Another tool that can help us is the Porter's 5 forces model. We are looking into expanding into a market that is new to us, we need to evaluate the threat of buyers. So we need to evaluate threat of competition. We need to evaluate bargaining power of customers, bargaining power of suppliers, and so on. And last but not least, as a tool to help us in analyzing qualitative factors to consider when expanding into another jurisdiction, we can as well use the enterprise risk management strategy as a tool. So if I'm to expand into another country, there comes issues of strategic risks. Is it in line with our strategy? There comes an issue of operational risk. There comes an issue of regulatory risk, and so on, as part of the dimensions of the enterprise risk management. So these are some of the tools that you can use when you're asked to evaluate whether or not to expand into a foreign or an international market that you ordinarily would not operate in. So I understand there's a specific video lecture which discusses qualitative factors or how you come up with qualitative factors to consider. So as part of this international financial management, you might also need to consider these qualitative factors. So thank you for going through international financial management. See you next time.